Are we live? All right, how you doing, Brucey?
I am doing extremely well, Costa. How are you?
Good, mate. Good. This is our second podcast now.
I know. I'm like doubly excited as last time, because now we'll have two podcasts, and two is double one, and like it's twice as big as one. So therefore, I am twice as excited.
Man, imagine what he's going to feel like when we're up to the 10th or 20th podcast.
I know it's going to be like excitement increases on exponential scales. I'm excited about the level of excitement.
That's when you know it's going to be a good one.
It's going to be fantastic.
All right, brother. So, what is the theme of today's podcast? Is it something we're going to be focusing on?
Well, I thought I would allow you to pick my brain on personal insurances, because that's an area that is potentially incredibly complex, and I get asked so many questions about it. So I was thinking that possibly you'd help answer some of those questions that people might have on personal insurance.
Okay, well, my first question on it would be, is it a waste of money?
Well, before we answer that question, let's go into
what it is.
What is personal insurance?
Absolutely.
I thought that would be an appropriate place to start. So personal insurance is different to general insurance. So there's two main types of insurance policies that you can get. One is general, the other one is personal. Contrary to popular belief, private health insurance is actually a general insurance. It's not a personal insurance policy. So I won't go into too much detail as to what the difference between general and personal insurance is, except for the fact that personal insurance can only be recommended by a qualified financial advisor. Okay. Having said that, you can get life insurance as a general insurance, and you can also get it as a personal insurance. And I'll go through the differences in policy definitions between general life insurance and personal life insurance. We'll go through that a little bit later, but there are. I'll explain what the what personal insurance is. There's four different types of personal insurance. There's life insurance, which basically, if you die, your estate gets paid the lump sum from the insurance policy. There's total and permanent disability insurance, which is if you don't quite die, but you basically are totally and permanently disabled beyond the point of returning to work. You will also get a lump sum payment to the size of the policy. There is trauma insurance. Trauma is it covers you if you have a serious medical illness, such as cancer, heart attack, or stroke. Cancer is obviously the big one, and so are heart attacks and strokes as well. But cancer can be very expensive to treat and to get access to good quality care. So that's what that covers. And then there's, in my opinion, the most important insurance that anyone should consider, which is income protection insurance. Income protection basically means that if something happens to you and you are unable to work due to bad health or an injury, that a certain percentage, for most companies it's a maximum of 75% of your income gets paid for the life of the policy, which may be 2 years, it may be 5 years, or it could be to age 65. It basically pays you your income whilst you are unable to work. So those are the four types of insurances that you can get.
Okay. I'm wondering, would there be heaps of loopholes in these things? To make sure that you don't get a dime? Or is it pretty straightforward?
Okay, that is an excellent question. Yes, there are many loopholes that are exploited by many insurance companies out there to decrease the likelihood of a successful claim. And look, I don't hold it against these companies. They've obviously got a product and they've got a policy and they're trying to make money. That's their prerogative. But the way I see it is, especially with these really important insurance policies, it's actually better to consider spending a little bit more for policies that do not have these loopholes. The biggest loophole that we find, as advisors, is it's particularly prevalent in industry super fund insurance policies. So when you join an employer, so when you start work with someone, you are being employed on a PAYG basis, they're going to need to pay your super to somewhere. If you don't tell them where you want your super to go, you will join that employer's default fund. There is almost a certainty that fund will be an industry super fund. Now, when you join an industry super fund, whether you know it or not, you're actually signing up to their insurance policies. So, and a lot of people, when I'm talking to them about insurance, sometimes they don't even know that they've got these policies. Some people have been paying premiums out of their superannuation for policies for 20 or 30 years, and they didn't even know they had it. So I do have a bit of a problem with that. But on the topic of policy loopholes, as per Costa's question, because you get these insurance policies automatically, you didn't have to go through any application process. There was no medical underwriting. Whether you're 15 and fit and healthy, or whether you're 68 and obese and a smoker, you get accepted into these policies regardless. So, and the policy wording is different, but most of the default industry super fund insurance policies have what we call a pre-existing condition exclusion, meaning that if you go to make a claim on that policy and there is any medical condition that they can link to what is causing you to make the claim from your medical history, then they can actually use that to get out of paying the policy. And I've seen some pretty tough decisions that have been made in the past. For instance, I'm aware of a case where someone had a serious respiratory disease, but the industry super fund insurer didn't pay out the policy because that person had asthma as a kid. And I mean, that's on the more extreme example, but the reality is you just don't know whether or not you're going to get paid. You don't know whether it's going to be a successful insurance claim with these kind of policies. When I say that the types of policies that I work with are a little bit more expensive, they are initially, but the industry super fund insurance policies, they eventually start to skyrocket in value. And here's another policy loophole, which is, in my opinion, it's a little bit cheeky and it's a little bit unfair. But a lot of those policies, the premium will go up over time, but the amount of insurance you have actually goes down over time. So the value of your policy decreases, which, I mean, that could be okay. I mean, if you're using life insurance to pay out, your mortgage or whatever, and your mortgage is reducing, that's okay. But if you're, for instance, if the level of your income that you're covered for is decreasing over time, and you're going to be reliant on that income protection insurance if something happens to you, then that policy is going to be no good for you. So when we consider the actual long-term projections of, the policies that I deal with versus, those kind of industry super fund insurance policies, long-term, the policies that we are talking about are, even cheaper. But even if they're not, insurance is all about peace of mind. That's what it's all about. The what you're buying with insurance is not, you're not making an investment into anything. It's not like you actually get any material good for that item. What you get is a feeling. You get to enjoy the feeling of knowing that no matter what happens today, you or your family will be financially covered. And to me, that is an asset worth having and worth spending money on.
And you're saying, though, that that peace of mind does not come with every single policy. It comes more with some than others?
Well, it's a fake peace of mind.
Yeah.
You may have the peace of mind, but
it's not actually going to happen for you the way that you think it is.
That's right. And then you might just get shot down one day because you've got something that happened in your medical history, and then that's stopping you from being able to get a successful claim. And you just never know what it's going to be because you just don't know what's going to happen to you.
So then, what can someone do if they're looking at policies? How can someone then actually make an informed decision? Would you say go see a financial planner who is looking at this stuff in detail, or is there something that the average Joe Blow can do on their own to be, more concrete about whatever choice they're going to make?
The most important aspect to consider with insurance is not whether or not you should have the insurance, but how much you should have. Because being underinsured is a problem, obviously. If you don't have enough insurance for your financial position, then the policies won't adequately cover you if something happens to you, and you will still be financially harmed as a result. Overinsurance is also a problem too, because the whole philosophy behind insurance is not so that you win lottery if something happens. We're not trying to make people rich with insurance. We're just trying to cover the needs that will arise when or if something happens to them. So knowing the appropriate level of insurance is the first step, and only a financial advisor can do that.
Okay.
So absolutely, whether you are 18 and part-time employed and a uni student, whether you are 60 and you're still in the workforce, you absolutely should have regular contact. And when I say regular, I mean maybe once every 1 to 2 years on your personal insurance situation, to make sure that the levels of cover are appropriate for your changing financial circumstances, and B, that you're getting the best deal. Financial advisors are not product salespeople. Obviously, we use products because insurance is a product.
Yep.
But we don't work for the insurance product providers. We work for the client.
That's right.
Quite often, there might be an insurer that comes along with a better deal, and if we can find you a better deal, and it's going to offer you a comparable or superior policy to what you've got now, then we can actually move you to the insurer that's got the best deal. Okay,
so let's say a new insurance policy comes out, it's a better one. How long until you find that? Are you looking at this every month, every 6 months? Would you be contacting your client saying, hey mate, we've actually found something that you might enjoy better? How does the process actually work in terms of changing?
That is a really good question, Costa. In my opinion, a financial advisor carries a huge responsibility for the quality of advice that they provide their clients. However, at the end of the day, the client needs to take some responsibility themselves.
Yeah.
So with my business, I send out an annual review invitation to every single client. So that's all 1,863 clients. And I really, really want every single person that I send an annual review invitation to say yes to that. If you don't say yes to that invitation, or if you don't respond, then nothing's going to change and you're not going to get the benefits of the ongoing advice.
Okay.
So, and yes, during those annual reviews, we do look at the insurance amounts, make sure they are still appropriate. If not, we change them. And of course, yeah, we make sure that the product provider, is still the most competitive for them. I'd like to think that the average age of the insurance policies that I have on my books is maybe 8 to 10 years,
Yep.
Which is a good thing because it means that the policy itself has been the most competitive for the longest period of time. So clients are getting the ongoing benefits of having not only the correct levels of insurance, but also the most competitive premiums for that.
Okay, and are you able to explain maybe or give us some examples of what are people going to be looking for in terms of, let's say they get an insurance policy. What are the costs? What are the general costs for a client of yours to have an adequate insurance policy in place?
With insurances, there's no advice fees. Well, there shouldn't be advice fees. If an advisor is charging you a fee for insurance advice, just definitely question them on that and ask them how they've arrived at that fee. So there's generally no advice fees for insurance because we actually get paid a commission. We get paid a commission from the insurer. They pay us an upfront and an ongoing commission, and that covers the costs that our office has to pay in order to provide the upfront and ongoing advice. And that's paid for by the insurer. It's not paid for by you, the client. The client only needs to obviously pay the premiums. Now, this is one of those areas where the cost can be vastly different depending on who you are. And the things that the four main things that impact on how much your insurance policy is going to cost is your sex.
Yep.
Men are actually more expensive to insure than women. Take exactly like the same circumstances, same age, same occupation. The man will cost more than the woman.
Yeah.
Men have lower life expectancy. We like to do dumb shit, like
jumping huge gaps.
A man who's never bloody or hasn't touched a skateboard in 20 years will see a kid with a skateboard and go, give me a go. Women tend to be a lot smarter than us guys like that. So sex does actually to play a part. Age, obviously. As you get older, you get closer to your life expectancy, and our bodies do, whether we like it or not, do start to get weaker over time. So as you get older, your risk to the insurer increases, and therefore so too does your premiums. The third thing is your occupation. So I'm lucky enough to sit in an air-conditioned office where the most dangerous thing that can happen to me is I might pinch myself with a stapler. Whereas someone who was working in underground mining with explosives is, that's obviously a higher risk occupation. So they're going to be a lot more expensive to insure. And lastly, your health history. So this is the key thing that separates these policies from the ones I was talking about before, the default ones for the industry super funds. You will actually be asked for your medical history up front, and it's quite an extensive process. We actually streamline it in our office. It generally only takes us about half an hour to go through it all with the client. So they ask you a whole bunch of questions. If anything is identified as being relevant to you, as in one of the questions is have you ever had high blood pressure or something like that, then the insurer will actually go into that and ask questions about that. Depending on the severity of the conditions that you've had in your health history, that could make the insurance premiums more expensive as well.
Okay.
So those are the four things that influence the cost of the policy.
There you go, mate. Thank you.
So to put it into perspective, I'll just be completely open and honest with my own insurance policies. So I'm fully insured because I see the value in it. And, I don't want myself or my family to be financially disadvantaged if anything beyond my control happens to me. So I've got quite an extensive property portfolio as well, which I've got debts exceeding 2 million. So my life and TPD policies are about 2.3 million. That's how much I'm covered for. I've got about 150k in trauma, and my business pays myself a wage of 80,000, so I insure 75% of my $80,000 wage. And all up, my insurance policy costs me about $300 per month.
Okay.
So about $3,600 per annum. So the way I see it, it's
a no-brainer for you.
It's a lot for those levels of cover, because I'm still quite young and I'm working in an A-rated occupation, and I've got a clear health history.
Mm-hmm.
It's for that level of cover, that's very inexpensive. But the average client of mine doesn't need $2.3 million worth of cover.
Yep.
It's designed basically to pay out debts and provide some financial breathing space.
Mm-hmm.
So the average, and I've actually done numbers on this, because I obviously do it to work out what business cash flows are and everything like that, because of the commissions, like I was saying before. The average premium paid by my clients is only around $2,000 to $3,000 per annum. Okay. Some are as expensive as $20,000 per annum.
Yep.
And some are as cheap as $700 per annum for the full suite of cover.
There you go.
But if you, without knowing your circumstances, it's impossible to tell you roughly what you'd be up for.
Yeah.
But it's affordable.
Yeah, it's much more affordable than I thought it was going to be. So you telling me that is good.
Yeah, absolutely. And to me, it is important, that feeling. It's not so much an additional feeling that you get. You don't get the additional feeling of bliss. You don't walk up and down the street celebrating that you've got life insurance. That's not how it goes. But it takes away the anxiety and stress of wondering, what if?
That's right.
And to me, removing that fear is
worth the outlay.
It's worth every penny.
Beautiful, mate. Thanks, Brucey.
No worries, Costa.
Great job, my friend. Anything else? I think you did a great job today, bro.
Oh, thank you. And if you wanted to have a chat about the insurances, first consultations are free. Private message us. We'll tee it up and we'll have a general chat about it.
There you go, guys. Thank you so much. Bryce, thanks for all the info.
I love you, Costa.
I love you too, Bryce.
Take care, buddy.
You too, my friend. I'll see you in about 2 minutes in the other room there. Thanks to all the listeners, to everyone who's listening, and hope you guys enjoy the info, and we'll see you next time.
Love yous.
See you later.